Imagine someone gives you a choice. You can make $1 million today, or you can take $1 and let it compound for decades. Most people would take the $1 million. But Warren Buffett? He understood something most people completely underestimate: time. Buffett didn't become rich off just one magical stock. He didn't make billions by trading every day. And he certainly didn't become wealthy overnight. In fact, a huge part of Buffett's fortune came later in his life. So how did a man who started with relatively small amounts of money eventually build a fortune worth hundreds
of billions?
And here's the more interesting question. If his strategy is so famous, why doesn't everyone simply copy it? The answer has less to do with intelligence and much more to do with patience, discipline, and human psychology. Let's go back to the beginning. Long before Warren Buffett became famous, he was just a kid
who was fascinated by money.
While other children were thinking about toys and games,
Buffett was already thinking about how money could make more money. As a young boy, he sold things like chewing gum and Coca-Cola bottles. He delivered newspapers. He saved his earnings. And instead of immediately spending everything, he kept looking for ways to turn those dollars into more dollars. By his teenage years, Buffett had already accumulated thousands of dollars. Think about that. Most teenagers are thinking about what they're going to buy this weekend. Buffett was thinking about assets. And that difference became extremely important later, because Buffett learned one of the most important lessons in investing. Money you spend disappears, but money you invest can potentially create more money. As Buffett got older, he became obsessed with studying businesses, not just stock prices, businesses. That's a huge difference. Imagine two people looking at the same stock. Is this stock going up? Buffett's approach was closer to, what exactly am I buying? What does the company sell? How much money does it make? Does it have strong competitive advantages? Does management make good decisions? And most importantly, is the price reasonable compared with the value
Of the business?
This became the foundation of Buffett's investing philosophy. He wasn't trying to predict what a stock would do next Tuesday. He was thinking about what the underlying business could become over many years. And that leads to one of the biggest differences between Buffett and the average investor. Imagine you buy a stock on Monday. On Tuesday, it falls 5%. What do? You panic. You open your phone, you check the news, you search, why is the stock crashing? Then you see someone on social media saying, "Sell now!" And suddenly, you sell. Buffett's mindset is completely different. If the business itself hasn't fundamentally changed,
A falling stock price doesn't
automatically mean the business has become worse. Sometimes, the market is simply offering you a lower price. That's an incredibly important distinction, because if you're buying a business, you don't want to sell it just because someone else temporarily values it differently. Most beginners struggle. They say they're long-term investors.
until the market falls. Then their
5-year plan becomes 5 days. Now we get to the real engine behind Buffett's wealth: compounding. Let's make this extremely simple. After the first year, you'd have roughly $11,000. The next year, you're not earning 10% only on your original $10,000. You're earning it on the larger amount. Over time, the growth starts generating more growth, and then more growth, and then even more. That's compounding. But here's the part people often misunderstand. Compounding doesn't look impressive in the beginning. The first few years can feel incredibly slow. That's why people quit. They want the results immediately. But Buffett had something most people don't: an enormous amount of time. And he kept reinvesting. That's why Buffett's story is not just about getting a good return. It's about allowing good returns to continue working for a very long time. One of the best examples of Buffett's philosophy is Coca-Cola. In the late 1980s, Buffett's company began building a major position in Coca-Cola. Why? Because Buffett wasn't simply looking
at a stock chart.
He was looking at the business. Coca-Cola had a powerful global brand. People knew the product. The company had enormous distribution. And Buffett believed the business could continue generating strong cash flows for a very long time. Here's what's interesting. Buffett didn't buy Coca-Cola because he thought, this stock is going to explode next month. He was thinking much further ahead. Imagine you owned a small part of a business, and that business continued selling products around the world year after year. Would you really care what the stock price did every morning? Probably not. You'd care about whether the business itself was becoming stronger. That's the mentality Buffett tried to develop. And now we reach the most important part of the entire story. If Buffett's strategy is so simple, why doesn't everyone become wealthy? Because knowing the strategy
and actually following it are two completely different things. Imagine the market falls 30%. What does the average investor feel? Fear.
oh no, what if it falls another 30%?
Now they're terrified. They sell. A year later, the market recovers, and they think,
I'll buy back in when things feel safer. But by the time it feels safe, prices may already be much higher.
this is the problem. Buffett's advantage isn't simply that he knows how to analyze companies. It's that he can remain rational while everyone else is emotional.
That's incredibly difficult.
Because humans aren't naturally designed to calmly watch their wealth fall. We want certainty. We want instant results.
We want to know what's going to happen next. But the market doesn't give us that.
Here's another reason Buffett is so difficult to copy. He waits. Imagine looking at 1,000 investments. You don't need to buy 100 of them. You don't even need to buy 50. You can wait and wait and wait until you find something that makes sense for your strategy and price expectation.
That's incredibly difficult for ordinary investors.
Because doing nothing feels like you're missing out. Bitcoin is going up. You want Bitcoin. AI stocks are going up. You want AI stocks. A meme stock is exploding. Suddenly you want that too.
The market is basically an endless stream of temptation. Buffett's discipline is being able to say no.
And wait. That's not exciting. It doesn't make great social media content.
But over decades, it can be incredibly powerful.
Now here's something important. You shouldn't watch this video and think, I'm going to become the next Warren Buffett by buying the exact same stocks. That's not the lesson.
Buffett has access to enormous amounts of capital. He has decades of experience. He has teams of analysts. And Berkshire Hathaway operates on a completely different scale from an ordinary person's investment account. You don't need to copy his portfolio. You need to copy his principles.
And there are 5 that almost anyone can learn from.
Lesson 1. Think long-term. Don't buy an investment simply because you think it will rise next month. Ask yourself, would I still be comfortable owning this 5 or 10 years from now? If the answer is no, you may not understand what you're buying.
Lesson 2. Understand what you own. Don't invest because someone on TikTok, YouTube, Reddit, or Twitter said,
This is the next big thing. Understand the investment. Know what you're buying. Know the risks.
And know why you're buying it. Lesson 3. Don't let emotions make your decisions.
When everyone is excited, be careful. When everyone is terrified, don't automatically panic. You don't have to predict the future, but you do need a plan. Lesson 4. Let time do the heavy lifting. This may be the most important one.
You don't need to turn $1,000 into $100,000 overnight. You need to invest. Keep investing. And give your money time. Because compounding powerful as the base gets larger. Lesson 5. Don't chase every opportunity. You don't need to own everything. You don't need the hottest stock. You don't need the newest cryptocurrency.
You don't need to trade every day. Sometimes, the smartest move is simply doing nothing. The biggest lesson of all.
How did Warren Buffett actually build his fortune? Not through one magical investment, not through constant trading, and not through trying to get rich as quickly as possible.
He built wealth by combining good investments, patience, reinvestment, and most importantly, time.
And there's something fascinating about Buffett's story. His wealth didn't simply grow because he kept adding more money. It grew because eventually, the money he had already accumulated became incredibly powerful.
That's what compounding can do when given enough time. So the next time you see someone online promising, make 10x returns in 30 days,
Remember Warren Buffett. The world's greatest investors didn't necessarily become wealthy by moving faster than everyone else. Sometimes, they simply stayed in the game longer, and that's the lesson almost nobody wants to hear.
because patience isn't exciting, but in investing, boring can be incredibly powerful. And now I want you to think about something. Real superpower wasn't for the next explosive investment, but letting time and compounding do the work. Then how long would it actually take an ordinary person to turn $10,000 into $100,000? That's exactly what we're gonna find out in the next video. Subscribe, and I'll see you there.